Good afternoon, everybody, and welcome to our latest tax update. My name's Craig Hughes, a tax director here at Brown Butler, and I'm joined today by our usual presenters, Vicky Hughes and Robert Wilson. Now, today we're going to cover off three main topics. I'll be talking a little bit around associated companies and why those rules are important. Vicky's going to pick up on IHT and talk around some of the changes that were announced in the October budget and the impact those are potentially going to have. And Robert will finish off with a session on R&D, primarily looking at the current landscape around inquiries and such like, but also changes, important changes that are happening there. In the next, over the next few months. So there we are. And if you ask questions, please use the Q&A facility on Zoom to do that. We'll pick them up at the end if that's okay, just to make sure we keep the time. We want to keep this to an hour maximum. But if there are any questions, use that Q&A box. And we'll pick those up later. And the webinar is being recorded, so if you want to go back and look at anything again, you'll be receiving a link for that shortly. So let's start off with associated companies. And I said there, don't forget the new rules, yet they are no longer new. I mean, came in April 23. And the way the associated companies rules now work are important both in the context of the corporation tax rate and quarterly instalment payments. And what we're looking at here are companies under common control. When we're thinking about the rate at which a company pays corporation tax, we've now got the situation that we had a number of years ago, where we have this marginal band between £50,000 and £250,000 of taxable profits. But that, of course, is prorated depending upon the number of associated companies at any time during the accounting period. So even if a company, if two companies are associated just for one day within that period, it will be reflected in the period as a whole. Now, we can ignore dormant companies, i.e. companies that haven't undertaken a trade or any business throughout the period. However, the revenue are likely to argue that any gainful use of assets is going to represent undertaking a business, and therefore a company won't be dormant. We'll come on to that now and just think a bit more, or talk a bit more around what that actually means. So in terms of whether a company is carrying on a business and therefore would be included as an associated companies, there has been various case law over the years. I've noted three there, two which went in the taxpayer's favour, one which didn't. So a company only receiving bank interest is unlikely to constitute the carrying on of a business. A company which only held property for the use of a controlling director and his family wasn't. However, a company that let property, made and held investments, advanced interest-bearing loan to the company was held to be carrying on a business. Probably not surprisingly, to be honest. We also have this concept of a passive holding company, which can be useful in terms of taking companies outside of that equation of being associated. And this is a special rule in Section 18F of CTA 2010. However, it's quite restrictive in terms of its application. However, a holding company will be treated as dormant if it has no assets in the period other than shares in 51% subsidiaries. It receives no income in the period except dividends, and any dividend that is received is flowed through to the ultimate shareholders. And it has no chargeable gains, management expenses, or deductible qualifying charitable donations. So it is quite black and white in terms of whether you fall within those criteria. If there is any doubts, then you're back to the position of having to argue whether the company is undertaking any business activity like we just spoke about now. And the revenue have been known to argue that if a holding company simply pays bank charges or filing fees, it will be considered to be active and therefore treated as an associated company. I have to say, in my experience, there doesn't seem to be a huge amount of consistency in that approach from the revenue. Quarterly installment payments, associated companies, I mentioned, applies when you're looking at the corporation tax rate and those marginal relief bandings. It also now applies when we're looking at quarterly installment payments and whether a company falls within that regime. And just as a refresher, there are essentially three key quantums that we need to be thinking of when we're looking at quarterly installment payments in terms of profits of the company: 1.5 million, 10, and 20. Now, 1.5 is important because that's the time at which you fall into quarterly installment payments. 20 million is when you fall into the very large quarterly installment payment regime, which has accelerated payments. And then the 10 million is relevant when we're talking about the grace period, and I'll come on to that shortly. Now, those 1.5, 10, and 20 million pound figures, normally you would just take those to be the taxable profits of the company. But it does also include dividends from non-group companies. So this can be relevant where you have investment companies that maybe have minority stakes in other companies. So whilst that dividend income itself wouldn't be taxable for the investment company, the income would be taken into account when you're looking at the relevant limits for quarterly installment payments. So you could find a company has taxable profits of less than 1.5 million, but nevertheless, it's within the quarterly installment payment regime. As I mentioned, it doesn't apply to dividends received from group companies. And for the purposes of the quarterly installments calculation, you look at the number of associated companies at the start of the accounting period, and then you divide those limits by that number accordingly. Now, remember, there is this concept of a grace period if a company isn't large in the previous year, and that's to help a company transition into the quarterly installment payment regime. So it's only in the second successive year that the company would actually have to pay quarterly installment payments in terms of breaching those limits. However, there is no grace period for very large companies. So this is the 20 million taxable profit figure, again, prorated for the number of associates. If you move from small to being very large, there is no grace period. You're straight into that regime. And the quarterly installment dates mean that you pay all of your tax in year for very large companies. For large companies, you pay 2 installments in year and 2 installments after the year. An important point to note around this 10 million pound limit, even if you're not very large, if profits are more than 10 million pounds, you're still in the quarterly installment regime for large companies in terms of payment dates, but there is no grace period. So I suspect we're going to find more and more companies falling into the quarterly installment payment regime now. And whilst the first period after the 1st of April 23 was probably a grace period for a lot of them, more of those companies are coming into it for 24 and 25. And of course, with the large company regime, you're making 2 of those payments in year, So it may be a case you don't realize you're in quarterly installment payments until one of the payments is potentially due. So what is an associated company? Basically, one company is associated with another if one has control of the other, or they're both under the control of the same company or person or persons. And this is all about not just voting control, but the ability to exercise direct or indirect control over the company's affairs. So it can be more, having a majority of the share capital, having the majority of the votes. It can also be around having a majority of distributable income or notional assets on a winding up or of a distribution. It can also be controlled through a shareholders agreement or other mechanism. Now, an important point around associated companies is this concept of bringing in or looking at that shareholders' associates when assessing whether somebody controls a company. So typically this is relatives, but you only have to include the shareholdings of associates if there is substantial commercial interdependence between the companies. I'll come on to just explain what that actually means. So if there is no substantial commercial interdependence, then we don't have to worry about associates' shareholdings. Now, if we do have to bring into account those of associates, who are we looking at there? Well, we're looking at relatives, and that's very broadly defined. It's basically linear relationship, but also going horizontally as well. So it's spouses, parents, grandparents, children, grandchildren, and also siblings. Business partners can be associates. Trustees of a settlement created by an individual is an associate. Any company controlled by them or any company controlled by them together with their associates. A point to note there at the bottom, you don't include associates of associates, so you don't kind of keep on going there. So we're looking at typically direct family relationships, and so normally not including aunts, uncles, cousins, nephews, and nieces, etc. Now, I mentioned substantial commercial interdependence, and this is a key point when we're looking at whether or not we bring in the shareholdings of associates when we're looking at connection. And there are three types of linkage here that are assessed to determine whether two companies are substantially commercially interdependent of each other. So one is financial. So this is to the extent that one company gives financial support to another. Economic interdependence. And so this is where two companies have the same economic objective. The activities of one benefits of the other, or they have common customers. And the third one is organizational interdependence. And so this is where companies share common premises, employees, or common equipment. Perhaps very often get that in family type businesses where there might be a central, HQ as such, but then there are various kind of businesses that are run out of there. The term of substantial isn't defined anywhere, rather unhelpfully. HMRC consider that you look at both the degree of interdependence and the period during which it exists. Now, when we're looking at whether two companies are under the same control, or two or more companies are under common control, HMRC practice is to look at control by what they call the minimum controlling combination. So this is the minimum controlling combinations of persons who control one company being exactly the same combination who control another. And here, again, you would include shares held by associates if there is substantial commercial interdependence. But that minimum combination must be identical in both companies. So it's defined as a group of persons who has control of the company, but which would not have control of it if any one of the persons were excluded from that group. So two companies would only be treated as associated with each other if the same minimum controlling combination persons controls them. And what I've done here is I've just done an example which hopefully just brings that to life in terms of how you look at the how you do the analysis on this type of scenario. So we have two companies here, Emery Limited and Saunders Limited. Now in Emery Limited, there are three irreducible groups of shareholders who could control that company. So it could be Watkins and Martinez. They would have 90% between them. Watkins and McGinn would have 55%, and Martinez and McGinn would have 55%. With Saunders Limited, there are four combinations there of shareholders who could control that company. We have Watkins and Mortimer, Watkins and With, Watkins and Martinez, and Mortimer, With, and Martinez. So what we're looking at here is there a common minimum controlling combination which controls both companies? And in this case, there is, because Watkins and Martinez as a combination can control Emery, but they can also control Saunders Limited as well. So those two companies would be associated for the purposes of these rules. And this is where it can get quite complex in terms of looking at clients and looking at other businesses you may have interests in, where there are different combinations of shareholders. There might be some commonality between shareholders, but different combinations in terms of how they hold their shares. And so it's important to make sure that whenever we're assessing the scenarios such as this, we're looking at the minimum controlling combination. Now, that's all I wanted to talk about as far as associated companies was concerned. Very much an update or a refresher, hopefully, in terms of what we've spoken about previously. But like I said, it's something that's becoming more and more relevant now. It's been relevant since 2023 as far as the tax rate is concerned. But quarterly instalment payments is probably an area where it can be overlooked sometimes in terms of the importance of establishing the number of associates. So now I'll pass you over to Vicky, who will talk about IHT and other matters.
Good afternoon, everyone. I'm going to be talking mainly about the inheritance tax changes that were announced in the budget and how people are starting to look at their options, and some additional information we've had over the last week because HMRC have issued a consultation document on how the agricultural property relief and business property relief changes affect trusts. And then towards the end, I'm just going to highlight a few other key areas that are changing quite significantly from the 6th of April. So turning to inheritance tax, in our last session of these, we went through the changes that had been announced, and now this is really aiming to summarise some of those, but have a think about what's sensible to do, but equally not rush into doing things that you may regret. So now there is, without doubt, more demand for advice on inheritance tax than at any time that I can remember. And this is likely to be due because it's the biggest increase in taxes since 1993. So with estate planning, it's not just tax that we have to look at, there's other factors as well. And the common phrase, the tax tail shouldn't wag the dog, is one that comes to mind. So estate planning is about a lot more than just the inheritance tax itself. It's aiming to find a strategy to help families pass on wealth in the best way for them, and one that meets as many of their needs and objectives as possible. So that is likely to have as a key part of it sort of tax and trying to minimise tax where possible. But other factors will be the level of control and protection of those assets that can be retained going forwards, for example. So the budget changes do really impact many families' plans or the plans that they had before the 30th of October for the transfer of wealth. And it has without doubt increased those tax bills significantly. And the periods at which those tax bills are going to be increasing are coming in over the next couple of tax years. So it is sensible to start having a thought and discussions about how these changes are going to impact. But it is also important not to panic and not to rush into making decisions that could be regretted just as a immediate reaction to these changes. It's sensible to work out what you've got, what your thoughts are, how you will be impacted, and then give yourself some time to think about them. As part of this, many individuals will need to review their wills to make sure that they're capturing reliefs and the reduced rates of tax relief sufficiently and effectively. And the final bullet point here is just a reminder that the proposed legislation isn't yet on the statute book. It is subject to change and the outcome of consultations. So that's just something to bear in mind. Although I don't think anyone's thinking that they're going to completely do a U-turn on any of these changes, there might be some tinkering, and I can come on to the consultation on the APR and BPR changes later. So continuing to think about, inheritance tax strategy and moving on to the next slide, the revised approach to retirement and estate planning means that valuations will become increasingly important, because it is no longer going to be the case that if you qualify for 100% agricultural property relief or 100% business property relief, that completely exempts, there being a tax liability on that. It's going to be capped, and you'll only get 50% relief after that. So the actual valuations concerned will be very important. And also it's possible that life assurance will play a bigger part in strategies going forwards, as in people now have a higher inheritance tax liability or are facing one, and whether they can actually do things to remove that altogether is a difficult question. And so it's likely that they might want to take life insurance out to know that they'll have a sum of money to help pay that inheritance tax bill in the future. Now, succession planning conversations involve sort of potentially multiple generations, and actually the actual tax liability itself does actually fall on the next generation to actually fund the inheritance tax payable. And again, the people that have had before budget day relied on 100% agricultural property relief and 100% business property relief to exempt assets from an inheritance tax charge will be particularly impacted here, and also those that are holding significant pension funds. Part of the strategy will be looking at whether, making lifetime gifts is appropriate rather than retaining the assets until death. But just a reminder here that there is the added complexity here where you're looking at non-cash assets, is that you have to think about the wider taxes that could be triggered. So in particular, thinking here of properties, for example, you have to think about whether gifting that asset during lifetime would not only have inheritance tax consequences, but could also trigger an immediate capital gains tax and stamp duty land tax liability, which would be additional to if you died with those assets and passed them on death. Other considerations are whether you are able to think of gifting assets away. Do you need those assets to generate income so that you can fund your lifestyle going forwards? And are you limited on what you can actually gift for any reason? And this is why life insurance is likely to be something that's discussed more commonly and quotes obtained to see if that is something that could help. And if you are thinking about life assurance, it's important to make sure that having that payout doesn't cause another asset on which you have to pay inheritance tax, which is like why life assurance is usually written into a trust, or there are more and more discussions now about whether that life assurance is held by other individuals so that the payout doesn't form part of an estate on which inheritance tax is payable. Now, there are opportunities to gift assets that qualify for agricultural property relief and business property relief before the 6th of April 2026 changes actually come in, but they are subject to the anti-forestalling rules, and I do mention those a bit more as a reminder on the following slide. So there are opportunities that could be explored as to whether individuals that have got 100% relief of these assets want to pass on these assets with the benefit that there'd be no immediate tax charge, either outright or into a trust. But the tax consequences of doing that differ between if you die before the 6th of April 2026 or you die afterwards. A reminder here that the £1 million allowance that there is not able to be transferred if it's not used on lifetime gifts or on your estate on death. So it's not like the nil rate ban that transfers to a surviving spouse, for example. So that's something that couples need to think about to try and maximise the amount of relief that they can get as a combined unit. And that may involve rebalancing assets between married couples during their lifetime. Now, because of the tax advantages that married couples or civil partners can get in terms of the ability to transfer assets between them without tax charges, it is possible that marriage might seem a more attractive proposition to people because it could give them an opportunity and potentially more time to plan around the inheritance tax so that you can include the surviving spouse's lifetime as well. Obviously, there's various different reasons why people may be together and not get married, but that is another thing that could cause people to rethink their current circumstances. Just a reminder here on the pension changes, these come in on the 6th of April 2027 and basically mean that pension funds and the death benefits associated with them will become a part of people's inheritance tax calculations. And there'll be extra administration on the pension scheme administrators as well. Now, this has a significant effect on individuals, especially those that have been building up large pots in their SIPPs and didn't expect there to be any inheritance tax under the rules that applied before the changes were announced in the budget. So because pensions are now going to become part of the IHT calculation, it does also mean that more people are likely to have some restriction or even have it tapered away entirely, the additional residence nil rate band. And that tapering applies where an estate is worth more than £2 million on death, and a married couple would lose the entire residence nil rate band available between them if their combined estates were more than 2.7 million on the death of the surviving spouse. So this special tax favoured treatment of pension pots that had meant that it traditionally over the recent years has been the last asset that anybody's touched or spent during their lifetime means that people's strategies and thoughts are changing because that's going to incur quite a sizable inheritance tax charge for a number of people. As a reminder here, wealthy individuals have kept assets in their pension pots as a tax planning efficiency. And so it is important to review what you want to do in the context of your whole estate and everything combined together. This is the same slide that I included after the budget, and it's just a reminder that the pension changes have various different strands to them, and there is potentially a triple tax where somebody with a pension dies over the age of 75. That's because you've got the inheritance tax on the pension, you've got the fact that beneficiaries would then need to withdraw that pension after the death, which would give rise to an income tax liability. And you could also have the fact that having the pension in the inheritance tax calculation has caused you to lose your residence nil rate band. And it's estimated that if you suffered from all of those, the combined effective tax rate could be as high as 90%. And I think this is something that is said to be being looked at, but we haven't had any updates on this. Now, thinking about some actions that you could be thinking about doing now, there's obviously, as I've discussed, less incentive to keep hold of pension funds and just keep them there and without accessing them. But as a reminder, the changes don't come in until the 6th of April 2027. So depending on how old clients are and how healthy they are, it is possible that if they died before that date, then they could wish that they'd done something different to if they died after that date. And pensions do still have very valuable tax reliefs associated with them, so they can still be a valuable part of planning. They have gross roll-up, so that while the assets are in the pension, they're not suffering income tax or capital gains tax, for example. Individuals can get tax relief on pension contributions subject to the qualifying limits. And it is still possible to have the 25% tax-free cash on retirement. So all is not lost with them. Now, if individuals had deferred taking tax-free cash, is it time to sort of think about what you want to do with that, think what you might do over the next couple of years? Obviously, if it's not needed or not thought to be needed during your retirement, then you might think about whether you access that and then give it away. Now, pensions are outside the remit of wills, so it is important to make sure that the expression of wishes associated with pensions are up to date. And again, here, those letter of wishes might change into what you're wanting to do with that pension fund, considerations such as whether you do want it to pass to a spouse or not. Because if you think you're going to die after the 6th of April 2027, then potentially the ability for inheritance tax not to be lost on the first death could be important, and it would extend the time to do some planning with that pension fund before there's inheritance tax payable on it. Now, in terms of how you access the pension, that will be impacted by what you're wanting to do with it, and whether, for example, you're wanting to take a lump sum and gift it away subject to the 7-year survivorship PEP period, or whether you're wanting to take a regular income and then potentially gift that as gifts out of surplus income, which, if it met the criteria, would be exempt from inheritance tax immediately and not have the 7-year survivorship requirement. Now, these are fairly technical points, but they are things that lots of people are considering with their pensions. And one of the things to remember is that if you are going to do it, you need to make sure that you meet all of the criteria for the regular gifts out of income. You can't plan to take a tax-free lump sum from the pension, keep it for a number of years and just give that, say, for the next 10 years. That wouldn't count as income for that period. That would be capital. So things that you need to think about are what support the family needs and when, and what can you do to try and make the passing of that as tax efficient as possible. Now, as I've said, life assurance is something that more and more people are likely to be considering, and in order to pay for that life assurance and try and make sure that the paying of those premiums, for example, if it's held in a trust, doesn't count as a chargeable lifetime transfer, might be to see if you can take withdrawals from a pension fund, which would count as regular gifts out of income to cover that and mean that they weren't chargeable lifetime transfers. Now, moving on to the business property relief and agricultural property relief changes, this is just a reminder of the key parts here, and the fact that it is going to be very much reduced from the 6th of April 2026. This affects individuals and it also impacts trusts, and I can make some more comments on trusts in a few moments. So moving on to the next slide, there's just a reminder at the top about the anti-forestalling rules. Again, that part of it is the same as I'd included when we did this talk straight after the budget. But what it does explain is that there's differences in how things are treated depending on when you make the gifts and when the individual dies. Now, as I mentioned, there's been a consultation published last week, towards the end of last week, on the reforms to inheritance tax, agricultural property relief and business property relief, and how it applies to trusts. Now, that's running for 8 weeks and closes on the 23rd of April. And after that, the government said that they'll publish a response document, carry out a technical consultation on the draft legislation for these changes later in this year. It has 9 questions that it's asking interested parties to feedback on. It includes 6 case studies to try and bring the examples to life, and has a summary towards the end of the application of the £1 million allowance to trust properties. And it's primarily discussing the inheritance tax treatment of relevant property trusts. And so it's asking people to feedback in those in relation to how these changes will affect trusts. It's not asking people to comment on how they'll affect individuals in their personal respect. So some of the key things that have come out of that and have given us a bit more clarity are that there will be 2 separate £1 million allowances for individuals and trustees, and that for individuals, the £1 million allowance will actually refresh every 7 years on a rolling basis. And so that £1 million allowance for business property relief and agricultural property relief will work in a similar way to the 325,000 nil rate band. Then looking at the trustees themselves of the trust, they'll have a maximum £1 million allowance for relevant property trusts, and that would refresh every 10 years, subject to some comments I'll come on to in a minute. Now that £1 million allowance would be available to be used against exit charges, and if it hasn't been used against exit charges in the 10 years, then it would be available to use at the next 10-year anniversary. There are some other parts that come out of this document that mean or suggest that they're going to be making wider changes to some of the calculations associated with relevant property trusts. Now, there are some technical differences between how an exit charge works if it happens before the first 10-year anniversary or after a 10-year anniversary. And basically what they're saying is that where there's agricultural property relief and business property relief as part of the calculation, it won't actually be taken into account when calculating the rate of inheritance tax on exits after the 6th of April 2026. Now, that doesn't mean that the £1 million allowance can't be applied to the distributions out of the trust such that their value might be reduced to zero. What that's making sure is that the rate is the highest it could be for the HMRC, and so they're basically diluting the benefit of the agricultural property relief and business property relief for the trust's exit charges. There is also an explanation that the rate of relief will only be 50% for shares, for qualifying shares listed on foreign exchanges which are not a recognised stock exchange. So that is the fact that they would only ever get 50% relief and they wouldn't qualify for any of this £1 million allowance. So that's similar rules to what they're saying will apply for AIM shares. Now, they're saying that in this documentation that the trustees' £1 million allowance won't apply to any exit charges on qualifying agricultural business property relief, which has actually gone into a trust on or after the 30th of October and comes out again before the 6th of April. Presumably that's because if people did something and didn't know how the rules were going to work, it's going to enable them to sort of revisit the position. So it'll be interesting to see if there's more information on that in due course. And they have confirmed that from the 6th of April 2026, they'll extend the option to pay inheritance tax over 10 equal annual instalments, interest-free, to all property which is eligible for any agricultural property relief or business property relief, regardless of the applicable rate. And at the moment, that's only to assets that qualify for 100% relief. Then there are some other discussions in there about anti-avoidance, anti-fragmentation rules that would need to be brought in if people have set up multiple trusts on or after budget day. So this is to prevent people being able to obtain multiple £1 million allowances if they set up a number of trusts, and also aiming to prevent valuation advantages. Because once, for example, shares are held in a trust, then those shares are valued on a separate trust by trust basis going forwards under the current rules. What they're saying is that when the individual is actually setting up their trust, you have to use related party rules, which can give a higher value. And so going forwards, they're asking people to comment on whether they think those rules should be extended so that settlors would have to value their shares where they've used multiple trusts across all of those, and the higher value would be used. So also, as well as that, what's included in there is that in terms of this £1 million allowance and what trusts can claim going forwards on or after budget day, if these multiple settlements are set up, is that if an individual has transferred qualifying property into more than one settlement, then they would have to look at how that £1 million allowance, that single allowance, was applied to those trusts going forwards. So it would be allocated across those various different trusts, and that would apply for the lifetime of the trust. So if you'd set up 4 settlements on or after the 30th of October, that would indicate that each of those trusts would only have 250,000 for the lifetime of those trusts at each event, and that's what would refresh every 10 years. And if one of those trusts stopped having any qualifying property, there's no ability to transfer the unused allowances across to the other settlements. It does explain that these rules won't apply to pre-existing trusts that contained qualifying property as at the 29th of October, and that those trusts would each benefit from £1 million allowance from the 6th of April 2026, even if a settlor transfers more qualifying property into them after that. So again, as the actual legislation comes out over the following months, it'll be interesting to see what happens, but that does indicate that it might matter what assets trusts held on the 29th of October as to how much of an allowance they'll get. So moving on to the next slide, just winding up, because I know I've talked quite a lot about the inheritance tax charges. From the 6th of April or the 5th of April, depending whether you're an individual or a different structure, the furnished holiday reliefs are coming to an end. Now, currently, if you qualify for furnished holiday lets, you get some favourable tax treatment and you can claim some extra allowances, for example, capital allowances on qualifying expenditure. Now, there aren't deemed cessations of capital allowances, so you don't get a balancing adjustment. And this is just a reminder that if you do get to claim some more allowances because you are a furnished holiday let, then you might want to think about incurring that allowable expenditure before the rule changes, so before the 5th of April or the 31st of March. Also, the furnished holiday let rules mean that you can apportion the income from those between a married couple differently from the actual beneficial ownership. And so without having to do any extra forms. So what you need to check is that if you have property that's a furnished holiday let that isn't held 50-50, that you might actually put some extra paperwork in to claim the look through to the actual beneficial ownership. That's because from the 6th of April 2025, if you're a married couple, the automatic rules apply where you have to split the income 50-50. Now, to stop those 50-50 rules applying where the beneficial interest is different, you need to fill in a Form 17 declaration and get it into the revenue within 60 days. So to prevent there being any mismatch, those forms actually need to be done on the 6th of April 2025 if the circumstances apply. And also, if you want to claim holdover relief on any gifts, those gifts would need to happen before the 6th of April 2025 for individuals. Then just a reminder that Making Tax Digital is coming in from the 6th of April 2026. So if that applies, then it's going to mean quarterly reporting. The revenue are starting to send out letters to individuals that could be affected, and they will be landlords, sole traders and self-employed with income over £50,000 gross. And actually they've given more guidance as to who will be caught by those rules, and they've explained that it will be individuals that have 50,000 annual in those categories within the 2024-25 self-assessment tax return that will have to move into quarterly reporting. And finally, just a reminder that there are significant changes to the tax rules, removing essentially the concept of domicile as a key factor for inheritance tax. So long-term residence tax rules are changing significantly from the 6th of April 2025. And so if you think that you're going to be impacted by those, it would be sensible to explore how. Thank you for listening. I hope that's been helpful, and I'll pass you on to Robert to talk about his R&D section. Thank you.
Yeah, thank you for that, Vicky. It's a very, very hot topic at the moment, as we all might imagine. Just a little bit conscious of time, Craig. So can you just skip forward to the contractors and subcontractors slide, please? There is a question in the question and answer box. Are we going to be getting these slides sent out afterwards? The ST answer to that is yes. So the previous slides that I've just skipped over are basically just a reminder of the rates and when they will apply from as well. But I just sort of wanted to focus for the next 10 minutes on, really speaking, HMRC's kind of current thinking and where they're sort of attacking R&D at the moment. Those of us that have been involved in it, I'm sure we've probably seen a number of inquiries coming through, a number of sort of concerned clients on the phone and other such matters as that. This is sort of one area where we have actually had some sort of recent guidance published from HMRC. It gives us a bit of an insight into what the sort of their issue is, if you like. So this sort of first slide, I mean, probably most of us know Under the sort of current rules as they are, if you are contracting out R&D, you are still able to claim for that cost, but it's limited effectively to 65% of your spend. Where HMRC was getting concerned, and it happened on a number of occasions, that the sort of the contractor, the main client, if you like, was engaging a subcontractor to carry out some R&D work for them. And then both companies were actually claiming for R&D for the same work. And it probably has come as much a surprise. It took quite a while for HMRC to realise that they'd made a mistake and had actually sort of either given relief or paid out to both clients in that situation. So this sort of first slide gives a bit of guidance around, how is the contractor, so the principal, going to be able to claim for R&D where they are actually engaging with a subcontractor. Very much what they are picking on here is the actual sort of contracts that the two parties had between them. And this sort of really, we can imagine anyway, is going to be a very, very sort of high level of evidence that would need to be provided for the party that's actually making the claim. But also as well, if the parties are in dispute as to who's actually got the right to make an R&D claim, it's really going to kind of come down to the wording of the contract. Obviously, HMRC aren't going to really care about a dispute between the two. But if you've got a situation where both are still claiming because they both believe they have the rights to claim R&D under the contract, then it's going to be some sort of careful analysis that would need to be undertaken to ensure that that's all properly documented and it actually sits with our client's favour as well. So it's very much something, if you are looking at clients who are in the process of engaging a subcontractor to carry out some R&D work, it's very much a good flag to say to them, get your contracts reviewed properly. Don't just sort of rely on emails. Probably sort of engaging a lawyer as well to actually sort of have a think about how that contract should be worded. All of that, of course, adds to a little bit of the cost involved on the client's perspective. Just the next slide, Craig. This is something that's just come out quite recently, because this is the flip side. This is situations where the actual subcontractor is able to claim R&D. And what the guidance said previously, because we have had a change as of the 27th, so last week in February. I can't actually believe it's now March, but there we go. What the sort of original guidance effectively was saying was, if the principal to the contract wasn't in any way, shape, or form aware that what was being undertaken on their behalf was potentially qualified for R&D, then all of the benefit for claiming R&D rested with the subcontractor. And then it kind of comes back to, how is the contract worded? What does that say? That sort of thing. What HMRC are now sort of saying is just some very subtle changing of the wording effectively. We've got this statement here. If it is clear that the contract or surrounding circumstances that the principal was aware that R&D would be necessary in order for the required product or service to be produced, it is likely that the R&D would be contracted to the company, the subcontractor in that case, in which case it would be the principal who would be the party that would have the benefit of claiming R&D. Again, obviously sort of ignoring any potential disputes between them. And this could potentially be, looking forward towards this sort of realm, if you like, of evidence. We're looking at sort of electrical contracts at the moment. One of our clients, they would go out to pitch or tender for a particular sort of piece of work. And as part of their process, they would always send out a tender document, a short presentation, which explains in a fair amount of sort of detail exactly what they would be doing for that particular client. And that would obviously be followed up with a quote. Now, if within that tender document, we've got even a line that kind of says this is completely new area to anybody, this has never been done before, it's completely groundbreaking, we're going to have to expend an awful lot of time in investigating this to see if it actually is technically feasible, then broadly speaking, that could give rise to the fact that the principal at that point was aware that R&D would be necessary to undertake that particular contract. In which case, again, the sort of benefit of claiming the R&D does flip back from the subcontractor to the principal in that particular arrangement. So very much the burden of evidence is changing ever so slightly. We just need to flag this to clients and make them aware for both subcontractors and the principal in that sort of relationship that they're going to have to sort of think very carefully about how they're actually sort of wording the correspondence between one another and any kind of legal documentation they draw up for the continuance of that contract. Next slide, Craig. Another sort of area where, again, from the 1st of April 2024, accounting period starting after, I think this is really, as you can probably imagine, a bit of a policy issue. The idea of R&D is to make investments in the UK attractive. We want sort of, again, I'll come to this a bit later, but sort of pharma medical type companies sort of actually working out of the UK, employing UK staff. So this measure here is very much sort of aims to prevent a situation where we've got a client who is based in the UK, operates out of the UK, but subcontracts, the apologies, maybe a bit stereotypical, subcontracts all our IT work out to India, for example, because it's much, much cheaper to do that. Makes complete commercial sense, but from an R&D perspective, HMRC do not like that. They would much rather it was kept in the UK. And if you actually sort of read through the guidance on this, which has been sort of wholly sort of summarized there, this is going to be a very, very high bar to get over, basically. I mean, it is still possible to subcontract work out of the UK to overseas and still claim R&D, but the requirements, the fact pattern, if you like, that needs to be present in order for that to be allowable from HMRC's perspective is very, very high. They give some fairly sort of fanciful examples within their guidance, the main one being that if you're undertaking testing work on volcanic lava, of course, you wouldn't be able to undertake that in the UK, so therefore it'll be necessary to appoint perhaps a local party, Vanuatu, somewhere where there's a volcano, Fiji, in which case you may be able to then claim, if you like, that that overseas R&D expenses is justifiable. So we are very much kind of limited to, is there a geographical requirement that we can't undertake R&D in the UK and therefore have to appoint somebody local? Is there some sort of environmental reason or even some social reason attached to that? As I say, I think the important thing here is that those clients who have been undertaking a lot of R&D over the years and have always kind of outsourced that to a non-UK third party, it's now time to start having a think about reviewing those sort of contracts that they've got with that sort of end subcontractor, and actually kind of thinking if they are going to continue, whether or not A, it's worthwhile making an R&D claim, or B, whether or not they can actually sort of change some of their operation to make that more worth their while and engage with UK parties. Slightly. Just on the subject I mentioned at the beginning of R&D inquiries, there is some data at the moment, sort of touted around various different parties that throughout the calendar year 2024, sort of anywhere between 1 in 4 and 1 in 8 R&D claims have actually resulted in an inquiry from HMRC, and that does seem to be regardless of how diligently those claims were prepared or success as well. As some of us may know, HMRC's tendency with R&D claims is to allow it and then ask questions later. And that's, of course, when the questions start coming through, is when the costs, if you like, of actually sort of resolving that do go up with the client as well. There doesn't appear to be any kind of strategy to that. It does appear to be completely random. I know from our own client base that we've got some very, very robust claims that seem to still get inquiries coming through. The process, if you like, for dealing with the inquiry, for those of us who have dealt with it, tends to be that HMRC Google something that's broadly similar to what the client has actually proposed. And if they can find something via Google, then that's it, the claim's refused, and it's up to the client then to provide evidence to the contrary. Fundamentally, HMRC simply do not understand R&D, much in the same way that we as accountants and tax advisors don't necessarily understand the ins and outs of a client's particular sort of piece of software development when they start using all the funny acronyms that you like to use in relation to APIs and things like that. But fundamentally, HMRC don't either. And there isn't really a huge amount of incentive, it appears at least anyway, for HMRC to get to the bottom of the issue and actually sort of understand and ultimately speak to the client, because obviously they're the guys that have been undertaking the work and they're the guys that know inside out. It would be far better to sift through all of the realms of correspondence and just get straight to the point. But we are in a situation where we are actually having to provide an awful lot of evidence and an awful lot of going back a couple of years to actually try and from the client side, trying to remember who was working on the projects and what they did. And that could be difficult when people have left the business and all sorts of things, really. So again, it's just something to be aware of if a client does get an inquiry. There is some comfort, I guess, in a way that it's not just them. There are an awful lot of others out there in the same situation, and it doesn't automatically mean that their R&D claim is bust. It's just really the approach that HMRC are taking. Next slide, please. So just with that in mind, I mean, this is so those of you that actually sort of completed the additional information form that we are now required to submit with each R&D claim. So we've got these sort of 4 main questions. They're covered on both slides, and again, we will circulate these around. These just give very, very high-level summary of our views on what we are actually required to answer for each of those questions. This is very much a bit of a change from the, I guess, kind of previous types of responses from the, I guess, kind of R&D specialists, the guys that just sort of pick the phone up and chase clients down when they've gone and searched on SIT code on Companies House. They tend to provide quite a woolly kind of background report, which just sort of sets out the actual product that the client's designed or the client is undertaking is completely new in the marketplace, and therefore must surely qualify for R&D. We're sort of almost sort of flipping that on its head a little bit, and the way that we like to think about this is the actual kind of end product, the goal that the client's working towards. That's great, fantastic. But again, coming back to this point, if there's something that's broadly similar out there, then how can that possibly be R&D, not just from a sort of logical perspective, but also from HMRC's perspective? The important thing is to get really under the skin of what they've been doing and, realistically speaking, kind of break it down into almost mini R&D projects that kind of all combine together towards this sort of one goal, this one sort of objective, this one development, and then actually treat each of those sort of mini projects, if you like, as an additional information form request. Go through each one step by step, answer all the questions sort of very, very sort of accurately, but also explaining, of course, why this was a technical uncertainty at the time that the project was actually undertaken. And what we, from our experience, been finding is actually thinking about things a little bit more in that sort of sense does make a lot easier to kind of draw out information from the client as well in order to be actually to answer these questions. But as you might imagine from sort of chatting that through, this does all add to the time that we're spending on sort of R&D claims. Of course, that does also sort of lead to an increase in costs as well. Potentially speaking, there is a point where we're going to have to say, at a certain level of actual sort of expenditure, it's just not worth anybody's while in actually sort of going through the R&D process from start to finish with all the extra kind of requirements that we are now required to actually sort of prove. And with the rates dropping as well, doesn't make it worthwhile for the clients even to sort of put their effort and time into it from an opportunity cost perspective. If they're sort of taking developers away from the front line, working on their own projects on an ongoing basis to answer some questions such as to get an R&D claim in for the previous accounting period, it may just be a situation where it's not worth the client's while unless it's sort of a very, very large claim, which is actually a bit of a shame really, because of course the whole point of R&D is to sort of encourage technical advancements and resolution of uncertainties and ultimately sort of bring some more jobs into the UK. But as I say, the harder it gets, the less attractive that becomes, unfortunately. So I think that was just a bit of a whistle-stop tour of HMRC's kind of current planning and thinking in relation to R&D, and that's the end of my part.
Thank you, Rob, and thank you, Vicky. Both really informative sessions there. I hope everybody got something out of that. As Rob mentioned there, we will circulate the slides around. Also, the webinar is being recorded, so you'll be receiving a link for that shortly as well to be able to watch it again at your leisure. Just looking at the questions, we haven't had any more in aside from the request for slides. We'll put in now. So, all being well, we'll have another one of these in about 3 months' time. We may have one sooner. We do have a spring statement coming out in 3 weeks' time, 26th of March, where it's not intended to be, or there aren't intended to be any tax measures in the spring statement. They're supposed to be reserved for the autumn statement. But there has been some, murmurings and mumblings over the last few weeks. Clearly, if there is anything coming out of that we feel is relevant, then we'll do another one of these sooner. But if not, we'll see you all again in 3 months' time. Thank you for tuning in, and we'll catch up soon. Cheers.
Thank you, everybody. Cheers.